All right, everybody, the 6th of March. Today's Thursday. Welcome to the show. We got the live stream here, Patreon, YouTube, you know the deal. We got another day of flip-flopping in the news where we're going to do the tariffs. Oh, we're going to extend the other tariffs now. We're going to extend not just the autos. This is just chaos. But anyways, we're looking at the SPY. 3 minutes chart. If you can see the picture fine, you can hear me fine. Just let me know in the comments, a brief check, and we'll begin right away. Okay, thank you, everybody. Let's begin here on a reminder. It doesn't matter which platform you're in, YouTube, Patreon, it doesn't matter. Just comment, Discord, have your comments and questions. We're going to catch them during the stream. But let's begin right here. So I want to look at two important support and resistance lines. So right now it appears that we kind of stuck here in sort of a distribution pattern too. So you have distribution patterns on the top. You have sort of distribution patterns here as the market tries to make up its mind where it wants to go next. And it looks to me right now that we have, let's call it 573.5. If we break that, because we've defended it 3 times now, 1, 2, 3. So breaking below that will open the floodgates for massive declines in the market. The VIX scenario. Now, 585, we got rejected once. Maybe you can consider this one as a rejection. This is the 3rd time. Can we give it another shot at 585, see how it's going to work? I think the market is not going to make it to 585. I think it's going to be between the range today, the 585 and 573.5. And then the make or break moment comes tomorrow with the jobs data. And the leading indicators are not looking pretty good. So we got the jobless claims with the federal government employees. And that number was higher. So my 2 cents here, we're going to look at the mechanics in a minute, but my 2 cents here is with the comments that we got from the Commerce Secretary right now, that maybe they're going to back off or extend the tariffs other than the autos. You're probably more likely than not going to close the gap. Whether we have a test to 585 or not, I doubt it. I think we're going to struggle a little bit as we begin to get closer to the gap, or maybe here around 581, 582, and then be stuck in range and have the break comes out tomorrow. But let's look at the mechanics here and see what they're buying in the zero DTEs, because that's going to determine where we go. We're now trading at 579-ish, right? Almost 580. So we have 88,000 contracts here traded in the calls, and most of it is buying volume. So we have a little bit of an upper hand here in the 580 calls. Now looking at the puts, look at that. Used to have the upper hand in the morning when we were trading at 575, but now we see them closing the 580, right? So this is closing volume. And the nearest in the money has 9,500, then 7,000. So the upper hand goes to the calls, and they can push it all the way. You see the 585 here. It's a possibility, but I think we're stuck between 582, 583 in or around that range. Because right now the upper hand goes to the calls. As you see, the volume right here, way bigger than the volume that you see nearest to the money in the puts. Looking at the VIX, I'm looking at the VXX here, but let's look at the VIX. 2 hours chart. So we got a little bit of that break, but this is why I love to look at the 2 hours chart, because it will dismiss any false breakout. But right now, inconclusive yet, because if we stop right here and we begin to trend down, it is still sort of a falling wedge-ish kind of bull flag pattern. I would not say that we're out of the woods, folks, until we get VIX 20 or below. Besides that, I think it's going to be, you might even see the VIX coming back up a little bit later in the day. It might drop to 22, then try to make it up again. And if it does sort of a higher low here, it's going to be problematic because it might head up again. But I think it needs a catalyst, and the catalyst would be the jobs data tomorrow. So this makes the session that we're in right now pretty boring, really, because there was a trade here once the secretary came out and gave his, the backpedaling thing. We got a rebound, but now maybe you can squeeze it all the way 581, 582, but I'm not seeing here. I mean, 580 is already close, but we need to see more volume here at the 82, 83. The puts, before they take the upper hand, we need to head down to, let's say, 577, because if we do that, 577, still the calls have the upper hand, folks, in the buying volume. So you're going to need to go down back to 575 for the puts to gain some advantage. So clearly the advantage right now for a trading perspective, if you're going to do the session, is for the calls and perhaps aiming to close the gap. Up to you if you want to trade that or not, but to me, the juiciest trade will be breaking out of this range right here, 585 or 573.5. And so far, we don't have that break yet. Looking at some of the bigger names, Apple, what do we see here in the hourly chart? It is still within sort of a bearish pattern here. So you got your bear flag played out. Then you have sort of another pattern here that if it fails before breaking above the top of this candle right here, that it could be an inverse ABC. Now, looking at the daily chart for Apple. Yep, not out of the woods yet, but I like to look at the 100 days. This is the 50 here. So if it breaks above the 50 and closes above the 50, okay, then we got something different going on. Maybe somewhat of a higher low here. But so long as it stays below the 50, it is still leading bearish with a confirmation if we lose 233 as support. Now, if we look at NVIDIA, still among the weak here. Moving averages are way up. But NVIDIA got to close below the low of this candle right here, 110, before we see a flush to 100. The hourly chart, I would still suggest that maybe NVIDIA will try to close the gap. All of them will do the same. And honestly, if you're looking for a drop tomorrow, you better hope that they're going to close the gap right now so don't have to worry about it tomorrow. And we get the jobs data, and you see a drop down. So this is going to be really volatile kind of trading period for anybody who's, if you're positioning the short-term options, you're going to lose your head. And this is why I said you got to have long-term put options and then cover with the shorter-term calls. And every time you make profits in a rebound, you begin to book profits. And this is kind of behavior, by the way, for bear market. When you have the main trend is the downside, but you see sharp rebounds, what we call a bear market rally. And the strategy that we've done in 22 was stick to the long-term puts and then buy once in a while when things get oversold. You buy the shorter dated calls for rebound plays. So it appears that this is the strategy that we're going to head into, but I want to show you something here. If we look at the NASDAQ futures, for example, and I'm going to look at the daily chart. We can clean everything here, but you guys can see what's going on if I do the weekly chart. If we lose 20,000, we're losing a trend line. This is the birth of the trend line from 22. So the tweet that I issued in the morning that few traders know that if we break the support that we got right now, we're going to enter a bear market. We already have the signs, right? We already have the signs. The high flyers are getting hit. The trend is becoming longer dated puts, shorter term calls. The rebounds are sharper based on the commentary, but the downtrend is still intact. If we break below the support, it's just going to be the confirmation that we're going to hit into that mentality, and then we have a whole different playbook in how we're going to trade. But one step at a time, we're going to jump the gun here until we lose 20,000 of support and break below the 200 days moving average in the SPY. Keep it in the VIX, trying to find some footing here. SPY stalling a little bit, but I think it might, again, stall a bit, then try to find a closure of the gap right here. Other names that are interesting, Palantir. So Palantir is one of the sentiment indicators that we have. I like to look at the 50. We're now struggling at the 50. The longer we have a struggle right here, and it doesn't break above the top of this candle, 93.62. So long as it trades like this, it'll probably gather the energy and then head for another leg down. And if it does, it'll probably be revisiting the lows right around here. Let's see where the 200 is, a little too far. How about the 100? Yeah, the 100 will be in or around that support, so it'll be 72.56 if we use the 100. So if I'm doing a trade on Palantir, a bearish trade will probably do the 85.75. Let's see how much that cost. PLTR. Go to the 21st, we go over the 85, and then we sell the 75. That's 322 to make 677. Not a bad risk versus reward with a 37% chance of profit. It's an okay trade, but can we go a little more aggressive here, like 80.75 maybe, but gonna reduce the profit. You can do it if this is too much as an entry price. You can do the 85.80. Now you're spending 200 to make 3. You have a higher chance of profit of 40%. And if we hit 80, then you roll this down to 80 and roll this one down to 75, and you still got skin in the game, and the trade keeps going. So that's an idea for Palantir, because so long as we trade in consolidation right here, it's going to break to the downside. Tesla, it caught some rebound, but it's still in the weaker side. I think we have selling exhaustion. That's what the chart is saying here. We have selling exhaustion, meaning we're inviting the buyers to do their thing. But the buyers are nowhere to be found, even with the comments that we got from the secretary right now, the Commerce Secretary. It's not really, I mean, it's doing some work here in the indices, but not so much in Tesla, in some of these momentum names. So it's the same drill with Palantir, by the way. If we continue to trade below the 200 and the buyers don't show up, then you have to look at the weekly chart, and we're going to have a revisit to the 200 weeks moving average, maybe below. So it's really a matter of time in these momentum names like Tesla and Palantir. Time matters more than the price. Now let's do some of the movers of the day. To the upside, Teladoc, Zscaler, the VIX, obviously Papa John's. This is something that we talked about in the previous stream, that maybe you have sort of a bull flag going on and an inverse in his shoulder, if you can see it right here. Inverse in his shoulder, and the idea is we have short covering in Papa John's, because I mean, it's been a garbage name and huge shorting position that probably needs to be covered. Alcoa, that's tariff related, and then Nutrien finding a footing. Mosaic finally, at least trying to find some footing, but we have the top of this candle right here. 24.90, we're close enough. Let's see if we can close above. Fastenal has been interesting to me, but it's a highly cyclical name. I mean, it looks pretty good here, folks. It looks as a higher low and a higher high, so it has a possibility, but I don't want to open new positions right now because the market is so jittery. When we see names like D.R. Horton and Lennar rebounding, it's sort of the brisk on stuff rebounding too, so it supports a rebound in the market, but it could be, again, just because of oversold conditions. And D.R. Horton still below 133, so if we don't have a close above, just an oversold rebound. Deere doing pretty good, part of the stagflation portfolio. Kroger with a rebound. Copper. Here we go. Copper in the weekly chart. Nice reversal kind of candle, right? You have sustained downtrend in FCX. Sustained downtrend that we can talk about as maybe kind of a falling wedge-ish. And we have momentum here turning from negative to positive. So think about copper as an idea. So long as the dollar keeps going down, copper is going to go higher. And at some point, the gains in copper will be reflected in FCX. Just a matter of time. I think it's being really undervalued. When you look at the movement in copper futures, you'll see that copper rallied already. If we expand this a little bit and have a line chart so we can see it better, you see the correlation, right, with copper futures, but FCX been lagging as of late. So it has plenty of ground to make up here to catch up with the price of copper. So that could be sort of an opportunity to add to the portfolio if you got FCX or you need some copper exposure. Some of the energy names rebounding, Valero, but still the damage here is too huge. We need to climb above the top of this candle by tomorrow, 126.43, before we say that we're out of the woods. Nintendo remains a hot name. We added Nintendo to the portfolio a few weeks ago. It's been hot, so we'll keep that. How about Instacart? Maybe a bottoming candle here. Let's see. Daily chart, Bollinger Bands. Maybe CART would be sort of a rebound play, oversold rebound play if you'd like. If you think that we're going to go risk on, you want some risk on exposure, maybe Instacart would be something we can do here. So let's do CART. And in this case, we're going to go with the calls. 14th will be good enough. 40 calls. Doesn't have a lot of volume though. So you're going to be careful with that. 21st doesn't have a lot of volume either. But the 7th, no volume. So the problem is that we don't have volume in CART, but it looks prime for a rebound. The laggards, let's see the laggards here. Marvell, obviously the chips are doing horribly. Is it an opportunity to buy, at least trade a rebound? You can do it for the day, until the end of the day. But I think that the damage is done here. Whatever rebound it's going to get today, it's probably going to flush down more in incoming days. HIMS, as I said, you got to wait till 27.5, 28 before you find a buying opportunity. Right now, it remains a short. We talked about Palantir, Starbucks, finally breaking down a little bit, just a little bit, because I know some of you have been trying to short Starbucks with no good luck here. So you must be a little bit happy today. But it's not really the cleanest break. Maybe in the weekly chart, let's see here. The weekly chart, maybe. Bearish engulfing candle, right? So you got to have, if you have any puts in Starbucks, you got to have longer dated expiration. Because you'll probably head down to the 20 weeks, but in time. So the 100 puts will work out. I'll do something such as Starbucks, 105. It's about a 3% drop. Let's go to the 28 just to be a little safer. And we sell the 100. Not a good volume here, but the idea is we're spending about 110, 115 to make 385. So that's a good trade here if we head down to 100, let's say within 3 weeks. That's Starbucks for you. AVGO got earnings today, so we're not gonna play with it too much. Let's see how it's gonna perform. My 2 cents, maybe it is a little oversold at this point, and AVGO might report good earnings and catch a rebound from falling wedge. So if I'm inclined to buy some of the, or play some of the earnings that we have today, I would probably do calls on AVGO. Netflix, Tesla, we talked about that, DraftKings. So it's a mixed picture here, folks. You see some of the risk on stuff, the majority of it is down. And the stuff that's going higher, it's mostly sort of an inflation theme, like the resources, the cores, the nutrients, the mosaics of the world, deer, more of the agriculture kind of cohort, and more of defensive stuff, like dollar-related stuff like FCX, and then more of the defensive formation. Anyhow, let's look at BTC here before we take your comments and questions, folks. BTC. We're looking at the 200 days. We're still not above the reversal candle, so there's no confirmation that Bitcoin is giving us anything today. But I do love to look at Bitcoin from a momentum perspective of where the market is heading. So you see the rebound right here, and now it's kind of frizzling out. So is that reflecting in the SPY? Yes, it is, right? So that's what it's saying here. It's just momentum indicator, pretty much. Okay, let's take some questions and comments here, folks. We don't need AVGO. Goodbye. We'll keep it at the SPY here. Good morning, Stone, Stefan, John, Jasper, everybody. JD reported triple beat everywhere. Short today all the way to 48. Now falling like a knife. No idea why. Do you see some weakness from the chart? Okay, let's. JD, it was positive in the morning. Yep. So here we have a profit booking move, right? So the investors here are saying that, okay, let's book some profit, do something else with it. Now, are other Chinese names acting the same way? Perhaps. How about the dollar? Let's look at the dollar. Maybe that's trying to find some footing. Look, I would say that the dollar is really, really oversold right now. And more likely than not, you'll see at least an attempt for a rebound, as we've seen right here. Once you breach below the Bollinger Band, at least an attempt for a rebound. And if that is the case, if the dollar rebounds, then you see a pullback in the Chinese names even more than we've seen today. So with JD, I would say if you have hedges, if you have puts, you're good to go. You just keep them as it is. If you want to book profits at this point, that's okay. Book profits and then wait in the sidelines for more clarity before you enter or do anything about it here. Because, look, all in all, JD, if we look at the weekly chart, this is more of maybe a cup and handle formation, but the handle could take you a little lower. So if you look at it from the daily chart perspective right here, you can see that cup, but the handle might take us a little lower before we hit higher again. So stay bullish, but at the same time, if you made profits from it and you need to rotate the money to another trade, just take your profits and wait in the sidelines for a better opportunity. I'm going to keep it at the SPY here, folks. 3 minutes, trying to find some footing again. WTF is going on? What's going on is the Commerce Secretary came out. I mean, it was supposed to be really ugly in the morning, but came out now saying, oh, we might delay the other tariffs now. We might give some exemptions to the other tariffs. And again, at some point, the frustration is going to ensue in the market. Okay, what do we trade here? What do we invest? You see that the volume is low across the board. You'd think that with a backpedaling like this, we will see huge participation in the market, and the options market volume is going to go an explosion in the calls and all of that. But we're not seeing that because the traders are frustrated. Do you want to have a tariff policy or not? And if you're going to have it, go all the way. But anyways, this kind of flip-flopping at the end of the day, what is an extension going to do really? What is it going to do? You're just kicking the can down the road. And there is no negotiation. All of the other countries showed that every time you're going to place any tariffs, they're going to retaliate right away. Anyhow, let's see here. The Bomba got a large trade desk position. Let's look at trade desk here. You're moving up. You're getting off the lows and turning positive today. That's a good sign. Look, in time, it's going to make it. The moment you have any appetite for risk on, this guy's going to rebound in a big way because we have a lot of short covering that has to be done. So stick with it. You have a good place here. I have the 70 calls. I'm going to stick with it all the way to the 21st. The jobs data, no one says the jobs data on ADP and Challenger job cuts has been dismal. Trump also mentioned there will be more pain. Do you think the market will flush on bad jobs report? If so, what is the weakest stock to hit? NVIDIA target on sell tomorrow. Lotto put fly. Okay, got it. So if the jobs data come out ugly, what's going to happen is bond yields are going to head down. So right now they're rebounding. Let's see here if we're catching any near support. Not even close to the 20, but it's a rebound for now. If the jobs data comes out weak, we're going to see a flush down in bond yields. TLT is going to go higher, and that's going to be really bad for risk assets, any of the risk assets. And I would say the consumer stocks, like the cruises, the airliners, the banks, they're going to get ahead really, really hard. And of course, the dollar is going to head down, even though it's a little oversold right now. You see, the tricky thing with the dollar is you might have a bad jobs data, And then the market says, you know what? I need to go to the ultimate hedge here and firm up the dollar. So the dollar is kind of hard to predict of how it's going to act. We know how bond yields will act. Bond yields will go down right away. But when it comes to the dollar, it's going to be really hard. So I wouldn't use the dollar cohort as a bet for the jobs report, meaning I'm not going to use copper or Nutrien or Mosaic or the chemicals or gold as my bet in the jobs data. I'm going to use something that is more in the yield-sensitive cohort. So if we have rebounds today in the IWM and any of the risk assets, and we think that bond yields will go down tomorrow because of weaker data, then think about that kind of risk-on cohort on the yield-sensitive side to use to buy your puts. And of course, the VIX is going to spike, and NVIDIA is going to be one of the biggest names that decline because it has the biggest weighting in the VIX. Apple has shown a degree of resiliency despite the VIX going higher, so I would not recommend Apple as the pick for the short, but NVIDIA would be better in the big caps. You got to think about Amazon too, because that's a consumer name. But I would say the airliners, the trucking, the cyclical side of the economy, the shipping companies, the cruises, the banks will be the biggest casualties. So if you look at JPM, for example, JPM, let's look at the daily chart and give it a minute here. Screwed my color. There we go. We're still in this formation of an inverse ABC. Could get ugly, folks, because if you plug in the Bollinger Bands, we're at the lower bands and it's causing a little bit of support. But if you have a bad jobs data, you might get the flush all the way down and find support around 239. So the XLF puts, JPM puts, Bank of America puts, all of them would work in the weaker jobs data. Don't forget about the asset managers. Goldman Sachs, Morgan Stanley, they're going to get hit really hard. If we see, look at Goldman Sachs. It's been since 23 and a huge divergence of the 200 days moving average. So at some point, you're going to go down there. Either consolidate and wait for it to catch up or head all the way down there. So all of these will be impacted by the jobs data. Ryan, good morning. And then we have holding a large position in JD. Yeah, look, should I close and call it a day? I think you should, right? Because if the investors are saying, okay, we got the report, it's pretty good, beat across the board, but they're going to use it as an opportunity to book profits, you got to do the same. Hold the cash and look for another opportunity right now. Senior, so China is stimulating. EU countries' bonds are skyrocketing while countries in recession. So they will stimulate too. Do you think if we get a hard correction, we're expecting a U.S. to start printing? We're already printing as we speak. But the problem is if we print, you're going to cause inflation, especially if we do it here. So that's not a choice for now. I think that what's going on in the European the bond market is stunning, and it's leading toward a recession phenomenon. I know the market's been going higher in Europe, but wait till you see those tariffs hitting the European Union, and then you see a different reaction. If all three major economies are stimulating, oil, gold, and BTC calls, you got to understand something, that stimulating for the wrong reasons actually causes more declines in the indices. We've seen that back in the financial crisis, and every time the Fed stimulated for the wrong reasons, it was bad. The only thing that is, the only stimulus or any stimulating move that would stick would be a bailout. If the government hands free cash, that's positive. That's always bullish. But when the Fed cuts rates, for example, or ECB cuts rates to mitigate a recession problem, usually that exacerbates the problem because it shows that the central banks are also now coming to the same page, that the economies are slowing down and heading into a recession. Do I go with oil in a recession? No. Do I go with gold? Yes. Do I go with BTC? No, because that's a risk-on indicator. Deep Singh. Thoughts on the KMI trade. So Kinder Morgan, let's take a look here. Still trying to find some footing here. So I'm going to stick to the 27 calls because it could be sort of a bullish formation. We see a breakout. Momentum is still positive, so we'll give it the benefit of the doubt. Let's see what crude is looking like today. Crude still in a recession mode, so that's going to add pressure in Kinder Morgan. But look at the degree of relative outperformance by Kinder Morgan. Despite the fact that oil price has been going down, it is trying so hard to move up. So at the moment we see crude rebounding, Kinder Morgan is going to have a big pop to the upside. So I want to stick with it right now. No one. What would be the target for a market sell-off? Tech, because it is the market leader, and overvalued, or banks. Well, I just said that the tech is going to get hit because of the VIX, but you got to be careful because Apple is showing degree of resiliency against the VIX. VIX goes higher, Apple doesn't care, and that's something new that we haven't seen before. But Nvidia is the one that's getting impacted. Google is the one that's getting impacted. So you got to stick to the other names outside of Apple because the market shows us, at least in the last few weeks, that it's treating Apple as safety for now. That could change as we get more data. But I would say anything in the big caps other than Apple would be okay because you're playing the VIX and then you're playing bond yields. But I would say stay away from the dollar cohort because you could see a bad jobs number and then this guy goes higher either way. And by the way, if that happens, the market is going to flush down in a big way. If you see bad jobs data and the dollar goes higher, that's signs of panic. You're going to see the VIX exploding and see flush down in the SPY. So just keep an eye on the dollar. It's going to be a really important indicator tomorrow. Mav, good day, Baba. Puts for tomorrow. Bought the 138 puts, showing some weakness all of a sudden. Yeah, well, we see with JD pulling back, and again, Baba needs to correct here. These conditions cannot be sustained because you have a really, really elevated MACD reading. The RSI is still overbought, so I think we still need to see more. I think it is all in all a distribution pattern, and it should give us a break to the downside. And we find better pricing after that. So stick to the 138 is the one that you got. That's close enough to the money. You got a good expiration date. Stick with it. Jeff, good morning, man. Any thoughts on UAL looking into buying naked puts for the 80 strike, March 21st? Again, it's going to be highly dependent on the jobs data. So if the jobs data come out bad, yeah, I think we'll see UAL. I mean, it is at the lower bands, and usually I don't like to enter shorts the lower bands right here because more likely than not, let's clean up the chart here. More likely than not, you'll see rebounds, right? So you see rebounds every time, at least consolidation, every time you're at the lower bands. You see it here again. So every time we're at the lower bands, we find support. Meaning if you go to the 21st, it might go against you if there is another move higher tomorrow. Then the trade goes out of the window right away. If you want to do the 80 puts, you probably want to go to the weekly chart. In this one here, if we drop down to the weekly Bollinger Bands, that'll be around 80. But that means they have to take a month or beyond in the expiration to play that. So I would say if you want to play UAL, maybe you want to do a lotto for tomorrow. And that's it. So you're going to play the hourly chart instead. What you're going to play basically is, let's see, if we stop right here, maybe a bear flag, and down we go again, depending on the jobs data. And if you want to do a lotto for tomorrow, I would use it in a butterfly form. So it's going to be a long butterfly, and let's say 90, 85, or let's say 87, and then 83. So it's going to be something like this, but we don't have a lot of volume right now. Yeah, the spreads are bad. Going to the 14th, spreads are still bad, so let's do naked. Spreads are bad all the way to 85, but 85 is a little bit too much for tomorrow. For the 21st, it's going to cost you quite a bit, so I would say that even if you're going to enter for the 21st, you have to use spreads. If you're going to do 85, you still need to do 80 to reduce your entry costs, just in case there is a rebound. But not my favorite trade, be honest with you. Not my favorite trade because it is at the lower daily Bollinger Bands. Let's look at something that is not this oversold for a drop in tomorrow's session. And maybe if we have rebounds today, where we see the market rebounding and other names going higher, maybe that's going to open the path where you see the oversold conditions no longer. And you have more room for a drop tomorrow. Let's wait till the end of the session and then figure this out. UD Weed. Mav, can you review Amazon chart, please? Gap fill today. So Amazon is going to be really sensitive to the jobs data tomorrow. And in the daily, it's still at the lower bands. See, it's expanding the bands. But if you play daily or weekly expirations, you could see rebounds on the puts and then you lose value. So the key here, when any stock, any chart is expanding the bands to the downside, is to have longer dated puts. And you also have to be mindful that the momentum at some point going to turn bullish. It doesn't mean that we're going to go higher. It means that we could consolidate and then head down. So you have to look at the opportunities for entries in the puts when you see crossings like this. When the MACD begins to go from bullish to bearish. These are the best opportunities to enter puts, but not around here. Now, on the weekly chart, can we go further to the downside? Yes, because in the weekly we have a crossing and we have momentum. The bearish momentum is still accelerating. So you have the lower Bollinger Bands of what, 90? You probably want to do the Amazon. In this case, you want to do the 200 and then sell the 190. But you have to go, since we have the 7th tomorrow, so we need to go, that's 1 week, 2, 3, 4. So go April 4th. Because if you're going to play the weekly chart, you got to get a rebound. So in Amazon, sooner than later, unless there's a scare tomorrow, you're going to get a rebound in the daily. So you have to account for that. So here, the 200, 190 will cost us about 270 to make 730. It's a pretty good chance of profit. Break even only 3.8% in 4 weeks. That's reasonable. Now, some folks will hedge, of course, buying calls, let's say at 210, but let's go to the expiration date, that is the 14th, for example, and then, yeah, this one will be a little too expensive, but we can mitigate that by doing the 215. So some folks would do this, where you have a main trade for longer expiration date, then you have a hedge for a shorter expiration date. But again, if you're going to hedge, yeah, your chance of profit will go higher to 50% that you're going to win in the trade. But it's also going to cost you. It's going to increase the cost and your profit is going to go down. So I like to be a little bit decisive here. And if I'm going to go against Amazon, I'll do the 200, 190 for the 4th. And then I'll use a hedging strategy either in the 0 DTEs, SPY, or I'm going to use another name, XLK or Apple, as a hedge against the Amazon position. Johnny, hey Mav, or let's do this here. How do we position our portfolios today? If portfolio calls heavy, do we trim and add more puts? What do you think? If you're talking about your stock portfolio, what you're seeing right now is the risk on is down. Even the risk off is kind of lagging a little bit. But I would say that if you're gonna, let's see, if the dollar rebounds tomorrow, you'll see a lot of these names that went hot coming back in the metals. That'll be an opportunity to buy. If these names and utilities continue to pull back, that's going to be an opportunity to buy and add to the portfolio. Any of the defensives, if they keep coming back down, that's an opportunity to buy. The telecoms, same thing. Some of the insurance names will be under that strategy too. And here, if we look at the big pharma names, so the dips and stagflation, those are Bible. You have to add those to the portfolio. Now, if you have any risk on, if you have risk on stuff, let's say in the software or technology or the cyclicals, my 2 cents is either we're going to get a flush down tomorrow, where we have a climactic move, and then after that comes a big rebound. Or we're going to get a jobs data that's not so bad, and we see a rebound right away. So how do we deal with that? Because at the end of the day, if we're going to shift into a bear market, risk assets not going to do pretty good. So the strategy in risk assets, because I have some of them, and some of them are down positions right now, I'm going to use the rebounds as an opportunity to exit some of these positions at better pricing. But right now, since I don't know whether it's going to be a flush down first and then rebound or rebound right away, so I am hedging against some of these positions, buying puts, let's say with tomorrow's expiration. Say if you have Tesla in your portfolio, say if you have Amazon or Netflix or for any of the risk assets name, you're going to have the puts for tomorrow. Just in case we have a flush down, we can exit at the price that is at least better than tomorrow's price. But if we have a rebound in these risk assets names, I'm going to use the rebound as an opportunity to lighten up, if not eliminate a lot of these positions, and then concentrate more on building a defensive portfolio. As far as the trading strategy, if you have calls and puts, like I said, you're going to have longer dated puts shorter dated calls right now. That's the strategy for bear market. It worked out pretty good for us in 22. Because, again, the daily is not oversold, by the way, in the SPY. So the daily still got plenty of room to go to the downside. It's just you need to break that support of 573. And I think it's around the 200 days moving average. But the market makers are not going to make it easy for us. They're not going to break that support today. They're probably going to do it tomorrow via gap down. So before the end of the day, let's do at least a lotto on the SPY. So we'll do, let's say, SPY puts, and then we'll do something about the IWM in case we have a move up in the market tomorrow. So we'll do maybe SPY puts, IWM calls, or SPY puts, and then TZA puts to play a rebound in the IWM. So we'll do something before the end of the day to play the jobs data. But after the jobs data, we'll get more clarity on where we're going to head. You just need to break these walls, 585, 573 and a half. Okay, Johnny. Hey, Mav, you indicated today in your video that materials will probably go down when a recession happens, but before and after will be good. Which stocks would be best to look for? So heading into a recession when the dollar is devalued, you're going to see stuff like the agricultural names doing pretty good, the chemicals, gold miners will do okay. But then, of course, there's that rush to the safety of the dollar that's going to hurt everybody. But I would say that once the recession is underway, you're not going to see the agricultural stuff doing the best. You will see maybe copper, palladium, those kind of names doing pretty good. The metals, the pure metals, even gold. So how do we position in a portfolio from a stock perspective? I would say ALB becomes really interesting as a lithium play because that's really sensitive to the dollar. So ALB, it's been really, really hammered here for years. So that could be an opportunity to move up. You would also see the agricultural names, but again, got to be careful. Once the recession happens, they usually get hit pretty hard. But copper, FCX for sure. The gold miners, and I showed you guys what I have, which is WPM. It's been holding pretty good. And I have the steel ETF. So I have the steel ETF is the SLX. There we go. So I have that in the portfolio. That's going to be a play if we have devaluation of the dollar because of a recession. You'll see steel moving higher. Now, because you see here, let's see. So this was considered sort of a recession, the COVID recession, and steel went higher. Any devaluation of the dollar, and you see steel going higher. 2009, you see, once the recession was underway, steel was a good play. Leading into the recession, steel was a good play. But once we got that panic and the crash, it went down. So that's the problem, is you have to time it. You ride the wave as we get closer to the recession, but once we have things breaking down, right around here, Bear Stearns, of course, began breaking down. And this guy flushed. And by the way, that's the leading indicator. Steel and copper and aluminum, all of these are leading indicators for a market crash. So if you see them doing pretty good, leading into a recession fear, and then something begins to break in the economy and we see steel and the other metals heading down, in time, the market is going to crash. Because in 2008, for example, the steel ETF was heading down in a big way. Let's see if it was a bear market. Here we go. Yeah, more than a bear market. And then when did Lehman come? September. That's when the market broke. So I'd like to look at them as a leading indicator. But again, strategy really matters. That you hold them while we're heading into a recession fear. But then once you see the dollar firming up and we begin to start to see fears in the economy, you get rid of them. And the same goes for FCX, by the way. You see it right here. If we go back to the financial crisis, you can see that it did pretty good. As the dollar was devalued, folks were afraid about a recession, huge rally in FCX. Then a huge crash, and once the recession was underway, it rattled back up again. So that's going to be the pattern in the metals. Gold, though, shows a different pattern. So if we look at gold, let's go back here, GLD. You will see that gold has a better resiliency because, yes, it trades higher heading into a recession, as you see right here. During the crash, it gets hit because the dollar is being bought as a resource of safety against gold. But in time, the Federal Reserve, the government will respond with stimulus, and that's going to lead gold higher. So gold is the best asset, really, to hold heading into a recession, during a recession, and during the crash too. So I would look at the gold miners. This is the guy that I own here. Got to remember that WPM is not a pure gold miner. It has plenty of other metals here. So if you look at, and the dividend's not pretty good though. Dividend's about less than 1%. I got it for a little over 1% because I bought earlier, but right now the dividend's not pretty good. See Wheaton here. Gold, silver, palladium, cobalt. This is why I like it, because it has a diversified exposure to a lot of metals. GDX could be okay. GDX is doing pretty good right now. I would not pick the individual names, by the way. Don't be cute, for example, and pick Newmount, because that has been lagging. Doesn't mean that it's good. It's lagging for a reason. So stick with the GDX, Wheaton, and then pick the other metals to play the recession fears right now. Okay, Visa, you got the 340 puts for April 17th, Craig. Looks like it's rolling over. So Visa's part of the consumer names. I agree with you that maybe here, remember this buying opportunity that we talked about here? That was a fantastic one. But I think it's over now. I think for the credit cards, with what we have in layoffs alone, that's going to hurt the credit cards. So if we clean this up here, that's a bearish engulfing candle. That's a classic sign for a short. Now, if we use Fibonacci, just an approximate measure here, assuming that we have the top, we should probably head down to 320s. So I would go with Visa. Let's go to 17th. Be safe. We're trading at 347. So let's do here. Start with 340. You want to sell the support, right? You don't want to play the support. I mean, you can if you have a high risk tolerance. You can do that. But usually the way I like to do it is having spreads where I buy something closer to the money and then sell the support. So here we'll do 340 and then sell the 320. Here we're spending about 429, 430 to make 1,500. It's not a bad risk versus reward. Break even is about 3.3%. And you got plenty of time all the way to April. Yeah, that'll be a really good trade. Now, if you want to reduce the entry cost a little bit, you can do the 335, but now your chance of profit drops below 30, which I don't like. I like to keep my chance of profit above 30. So the 340, 320 is the trade that I would enter. Now, we can do MasterCard too. MasterCard will be the same thing. But the options here will be a little more expensive than Visa, but they trade the same way. AXP is another option. AXP looking a lot weaker, I would say, because believe it or not, the regular consumer still has to go to the grocery store. They still have to go to the gas station. They still have to pay rent. A lot of folks are paying rent using credit cards these days. So you're still going to see a reduction in volume, but they're still going to use the Visas and MasterCard. But when it comes to the affluent consumer, when the affluent consumer becomes jittery about the economy and the stock market, they're going to cut their Amex spending altogether in a big way. So you see bigger damage here. So Amex, let's look at the weekly chart here. The daily is oversold, in my opinion. So if you look at the daily chart, we're at the lower bands. So you can buy some calls if you think we're going to have a rebound tomorrow. Got it. But in a longer dated trade, I would do something here on the weekly chart. See where the 50 would be. The 50 would be down at 266. Okay, so let's do this. AXP. 280, then we'll sell the 260. How about if we do 270 and then sell the 260? Chance of profit above 30, check mark. Break even is less than 5%, check mark. Got enough time to play out, check mark. And you're going to spend about 300 to make 700. That's a pretty good risk versus reward. So that's another idea for you against the financials. Okay, let's do here. I bought the 310, 320, and 330 calls for MicroStrategy. Expiration date tomorrow. Could I cut and run at this point, given tomorrow's uncertainty and the potential for a VIX spike? What was the reason behind buying them, though? Do you think that Bitcoin is going to go higher? Let's see here. Yeah, clean up the chart a little bit. I mean, MicroStrategy is looking as changing into bullish momentum, so maybe you got if you have a butterfly, what I'm understanding here, you have the 310, 320, 330 calls. I'm pretty sure that maybe you're doing a butterfly, a call butterfly. If it's going to expire tomorrow, I would say give it a chance today. Let's see how it's going to work out till the end of the day. Maybe you'll see as the market improves a little bit, maybe Bitcoin improves a little bit, maybe you'll see MicroStrategy, although Bitcoin is kind of flushing down. So, yep, not looking pretty good here, but I would not keep it till tomorrow because my hunch is you have a lot of money left in it, and you're closer to the money right now, 310. Give it a little bit till the end of the day. If you're trading at 311, 312, then I would say book the profits and move on, or at least extend it to next week. A small family office says you don't like me anymore. Where? We didn't skip the questions. What are you talking about? It's not showing on YouTube. So type them again. Type the questions again, folks. If you don't see your question answered, it's probably a YouTube issue. Or type it in Discord. I'll catch it over there too. Good time to open Apple 225 calendar spreads. You buy April 17th, you sell the 21st. I don't know why we're fixated on Apple, though, because it's showing degree of strength. And I don't know if we want to bet against Apple right now. Pick against the weak. The weak is NVIDIA, the weak is the chips. Those are the ones that are showing weakness, so let's pick on those instead. AMD, I think that's might begin to frizzle down, head all the way to the lower range of the channel, so pick against the weak. Don't go against the strong. I would actually use Apple as a hedge. So if I'm short anything in technology and I'm looking for a hedge, I'd buy calls on Apple. Hey, Mav, could we see another short squeeze in Intel? Thanks. Let's see here. Well, the problem with Intel is the administration now went against the CHIP Act. So that's going to be problematic. That kind of took the short squeeze, at least cooled it off. A lot of folks began booking profits, but Intel still has a possibility of moving up, not with the same degree of, let's say, veracity here, but it might do a higher low and begin to challenge against some of these candles, break above them one by one. I would still say with the administration against the CHIP Act, with all of the uncertainty that we're seeing with the tariffs, I would still not go with it. I think there was an opportunity here in the short squeeze. That played out, but that's about it. I don't think I have an investing opportunity in Intel. Isham says MGNI March 21st puts are up 100%. Also on shares and down on those more than the puts. Roll down and out, take profits in the puts, or other ideas. You have the 16 strike. Okay, so this is part of the risk on, and it got hammered pretty good. So you have the 16, you have a few options right now. You can exercise and sell your shares at 16 and reduce your loss by $2. You can roll it down, but I think that at this point, you don't want to roll it down because it is oversold. If there's any possibility here that it could be for a rebound. So I would say another strategy would be book the profits from the puts. And if you get a rebound tomorrow or into next week, then you might be able to actually sell your shares at 16, if not above. And now you got the 100% gains that you got in the puts. And all in all, you're either going to break even or have a small profit in your exit. I still like the name as an idea, but the problem is if we don't have risk on appetite, it's not going to do pretty good. So my strategy right now, I have the same puts as you did. And my strategy is to book the profits from the puts and begin to buy the dip a little bit here, betting for a rebound so I can lower my average and then decide. If it rebounds in a good way and we have all clear in the market and the tariffs are not a problem and things are stabilizing, then okay, I'll keep it. But if we have a shift to a bear market and recession fears, then I'm going to get rid of it because it is still an overvalued stock. When you are holding a stock that goes up quickly, very fast, say 6% in 2 days in a row, in anticipation of earnings, is it wise to often sell that beating on a pullback or betting on a pullback since it went too high quickly. Okay, when you buy a stock and it goes 6% before the report is out, you got two strategies that you can do. You can do a sell covered call. You sell covered calls. If it goes higher after the report, then you limit it to that number. But usually what folks would do is sell covered calls and then buy some puts. It's called a collar strategy. So you sell the calls to finance the puts, and that way you're protected. Your position is protected either way. Some folks would say, no, let's just book the profits, wait for the report to come out, and then we'll decide whether we want to be in or not. That's really up to you at the end of the day. But I would say utilize one of these two strategies. Either exit, wait for the report to come out, or use a collar strategy where you sell a covered call and then use that money to buy a put, just in case there's a big flush when the earnings come out. Stefan, so I'll give you an example here. Let's say, what's going up today big? Let's say Okta went up big today or this week. Teladoc, okay, that's a good example, but it doesn't have earnings coming out soon. So in any case, let's look at AXP as an example. You are selling a call. Let's say that it has a report on the 21st. It's up big right now. You sell a call, let's say the 290, you get the credit, and then you buy a put. And what you're going to have here is, let's say your maximum pain is 270. Now we're trading at 280. You sell the 290 calls, you finance buying the 270 puts, you still got credit in your pocket, and now your shares are protected. Any flush below 270, you can exit at 270. Any pop above 290, though, you have to sell at 290. That's the downside to they call it a short combo here, but it's called the collar strategy. Anyhow, Stefan, you said you were betting on a short-term rebound on cryptocurrencies. There's an event in the White House tomorrow. Yeah, but the problem is MicroStrategy right now is flushing along with Bitcoin a little bit, so I'm not sure. I mean, you got an opportunity here to book some profits, but right here, I still think you have value, by the way. You still have good value in the butterfly. I would give it all the way, let's say, till the end of the day and then decide. SPY is holding pretty good. The VIX is down a bit today, so might still see MicroStrategy heading back to 316-ish, and that's going to be a good point where you close the butterfly altogether. Okay, we have Netflix. What level will cause it to close the gap? Okay, let's look at Netflix here. Netflix is going to show a degree of resiliency, by the way, in a recession. It's a little overvalued, and that's why it might drop hard, but it's going to hold better than the big cap names. Anyhow, we have the topping head and shoulder, and then we have supported the 50. So the 50 days moving average becomes the parameter. If we lose that, 951.54, close below that, then I say it's going to become a slam dunk pretty much to close the gap. And at that point, we might go with, let's say, the 950 or even the 900 naked. That would be an option. But right now, let's lose the 50 because Netflix still has a degree of resiliency against the recession news. Hey, Mav, what about a short-term Modine calls? Well, I mean, let's see here. Ticker is MOD. Where did we go? There we go. MOD. Do we buy calls on this guy here? It's broken trend, so not something you want to hold in the portfolio, but as a trade, can we have a thesis here that it is maybe a falling wedge? Yes, we can. We can argue that we have sort of a falling wedge here, and it might break the range and head to the upside. Not the most solid thesis, but if you want to play, that's okay. It's okay with me. You probably want to go to the 80 calls, though, and see how it works out. Your cut loss would be the low right here. So 72.49, any trade below, then you know the trade is not going to work out. And you exit because you're dealing with a falling knife situation instead. I don't have the SPY puts for now. And thinking to buy some betting on a downside either tomorrow or the next 1 to 2 weeks. Thoughts? We'll do that before the end of the day. But I don't want to jump the gun and go 2 weeks from now, and then we see a pump tomorrow. Then what is the point of holding 2 weeks till expiration in the SPY puts? So we'll do something for tomorrow's expiration, maybe Monday's expiration, just to account for the decay. And then we'll decide tomorrow. If we break support, which is 573.5, then yes, we're going to go big time. We're going to go with the 5,600 in the S&P futures. Hey Mav, I'm long NEO. It is struggling to get through and stay above 5. Do you believe it still has upside? It has the China catalyst, but it also has the recession problem where auto spending is going to go low either way. I would still see how this report is going to play out. Before the report, of course, we want to hedge. So we want to have a good put policy, but I think that the stock is down so much that the company is undervalued. I mean, look at BYD. That has exposure to the economy and recession. It's doing pretty good. XPEV, same thing. So I think that NEO is going to be a catch-up trade once this report comes out. I'm going to stick to my shares here. Small family office, please let me know your best guess. MNQ options credit spread. You want to do the puts, 21,000 and then 20,000. Okay. Please also commodity index long and JPY. So you want to do the macro E-mini here. You want to do a short in the macro E-mini. You still need to have that confirmation of break and support. So if you want to do a credit spread in selling the calls, or selling the puts rather, it might actually blow up in your face tomorrow if there's a flush down, right? So we don't want to do that. And if we're going to sell the naked calls, yeah, maybe the naked calls at 21,500 is more reasonable as a trade, but I'll be careful with the put though, because if there's a flush down tomorrow, it could be problematic for the trade. Doing the commodity index long, which one though? Because we don't have a lot of them, at least reliable ones. Now the JPY, my 2 cents, the dollar, whether we have a good report or a bad report from the data, I think it's way oversold, that it's just going to rebound either way. It's going to rebound in a bad scenario from the jobs data as a protection policy. It's going to rebound if it's a good jobs data in terms of alleviating the recession fears. And that means the JPY, we're probably going to pull back. So if we look at okay, well, what I was saying here is probably the JPY will head down tomorrow in the short run, but if you look at a weekly chart, for example, for the Japanese yen versus US dollar, I mean, it looks a classic sort of a cup and handle pattern. And we know that in Forex, in commodities, these kind of patterns, technical patterns are respected. And here you're making a higher low, right? So this is something we haven't seen for a long time in the Japanese yen. That's going to lead to I would say, more gains to come in the Japanese yen for sure, and more declines in the dollar, which will benefit commodities. But if we look at commodities index here, I think the one that folks are trading is a commodity ETF. DBC is, PIT is the most popular one, at least in my opinion, because it's more held than others. But it's not really a good ETF, to be honest with you, to track the commodities pricing. If you look at other commodity pricing, like here, ETF, commodity ETF, so DBC, popular, but still seats kind of underperforming actual commodities. So when it comes to commodities, you're better off just trading the futures. Pick whatever you like. You like copper, you like palladium, wheat. Palladium and wheat, we have proxies. We have some proxies in cocoa in trading Hershey's and Mondelez, for example. But I would say pick your individual futures at this point. Don't go with an ETF when trading commodities. I'm going to go to the VIX here, folks. Just check on the tape that we have today. We are still holding. Let's see, 2 hours. Yeah, we're still holding here. So the risk of the VIX going higher is not eliminated yet. And now SPY at 576.74, kind of rolling over here. At some point, folks, the trader is going to be frustrated. You're just going to get the hell out of the market. Rohit, Mav, thoughts on FMC? It has agrochemical exposure. It might benefit from the tariffs. FMC has a lot of reliance on China, though, and we all remember how painful it was. But will it benefit under these circumstances that we have right now? I think so, yes. Because you have tariffs, and that's going to increase the cost of farming either way. And these companies will use that as an excuse to raise the pricing, number one. Number two, with the dollar going down, it's going to be beneficial also for let's say, China to buy more stuff from FMC. Is it my favorite name to hold? No. I would say that we have plenty of other names that you'll be better off with. So, for example, if we go the full map here, Corteva to me is a better pick. ISL, that could be another one. So, look at ISL here. This one is more reliable. It has more of a similar pattern to FMC, but it's more reliable. And it pays a 3% dividend. FMC pays a 5.88. So it's not that attractive when you have a small dividend gap, but the stock still has a lot of problems. Now, if you look at Corteva, that's not a dividend paying name. It pays 1%. But to me, Corteva is the one that I got in my portfolio. And right now, maybe it's forming sort of a bull flag pattern, higher it goes. But the idea is that agriculturers will do pretty good in this period of the stock market. And that includes, by the way, Deere. That could be another option that you want to think about. ADM, I'd be careful with. So ADM, FMC, those are the weak. They have other problems. So I would stay away from them and pick, or at least pick the strong, or at least some names that are showing some strength right now. SPY, here we go. Now we're flushing down. Apple, let's see what NVIDIA is doing. NVIDIA is beginning to weaken. Let's see where the volume is leading us. In the calls, nearest in the money has 61, so we still have higher volume here. Oh boy, but we see higher volume in the puts now. In the money, 55, but that's selling volume, so we need to see the 576 being bought. If they manage to buy that right now, there is the possibility that we could go back to 575 again. So that's what they're trying to do. I think the sweet spot for the market maker is 575. If they can close closer to 575, they make the majority of these contracts expire worthless on both sides. Okay, if you wanted to buy way out of the money options, the price per contract under 50 cents, is there any point to debit spreads or butterfly spreads? No. If you're buying out of the money, you're buying out of the money. You're buying a lotto ticket, right? So I would actually look at my trades. Some of them have high risk, like 50 cents, 20 cents, naked, out of the money, shorter expiration dates. But am I investing a huge amount of money in them? No. It's the kind of investment where if it goes to zero, I'm okay with it. But if it plays out, I'll be happy. Now, we have, let's say, more mature trades where we can invest a little more. In those, we're picking expiration dates that are at least, let's say, 2 weeks or beyond. And we're picking strikes that are closer to the money. We're using spreads to reduce the cost. So depending on which kind of trade you're dealing with, is it more of the roll the dice kind of trade or more for serious trade? If it is a serious trade, and you're going to invest a lot of money in it, then you need a chance of profitability that is pretty good. You don't need a chance of profitability that, for example, since we have AXP right here, let's say you go way out of the money you go with the 240, for example, where your chance of profit is 1.3. So you pretty much, you're handing your money to the market maker. That's what it really is. Could it happen? Could we see a flush down of 14% in 2 weeks? Sure, that could always happen, but you're betting on outlier scenario. And even if we drop down, let's say more than 10%, you need a huge drop for you to make money. So this one would be sort of a rolling the dice kind of trade. A serious trade will be, as we talked about before, April 17th, and then we pick something such as the 270, and we sell the 260, right? Spending 3 to make 7. Chance of profit above 30%. So that's what I usually do. If I'm investing more money, I'm looking for a 30% plus chance of profitability. I'm looking at break even that is less than 5%. Okay, so let's see here what we got. Yeah, senior, you don't want to do anything spreads when you're going out of the money. There's no point to it. Stone, hey Mav, I took a small position in the 570, 560 puts for the 17th this AM. I'm holding the 580, 570 for the 21st, hedged with the SQ puts for tomorrow and TZA puts for next Friday. Okay with you? Any advice? Okay, so if we have the 580, 570, and you're going to go with the 570, 560, there's a degree of sort of a redundancy here. So you got to eliminate one and keep the other. And in this case, I would say if the market is going to rebound tomorrow, right? If the market is going to pop higher tomorrow, then what is the point of having the April 17th puts? Because those are going to go kaput right away. They're going to go out of the money right away and lose value. So those are probably going to be the 570, 560, or maybe at that time will be 565, 555. Those are going to be plays. The April 17th plays will be in tomorrow's session. If the jobs data is bad and we break support, then we can go with these trades. But right now, I would stick with the 580, 570 for the 21st. And then you have pretty good hedging in the SQ puts and the TZA puts. That's good enough. Okay, NEO is losing money at this point, and their fundamentals are not that strong compared to BYD. I agree. Even if it is down, it doesn't feel like a good comparison. I just see it from a value perspective that if you have sentiment improving in the Chinese automobiles, the EV makers, you'll see folks looking at XPEV and BYD and say, okay, I missed the move higher here. And if there's just some good numbers coming out of NEO, decent numbers, that's going to be a catch-up opportunity where folks are going to pile in. Because a lot of folks right now are looking for China exposure. I mean, you see them buying calls in the K-Web and the FXI, chasing Alibaba. Everybody wants to chase the Chinese stocks. So I think if we have NEO delivering a good report, you'll see that kind of chase mentality in NEO. SPY beginning to lose some momentum here, folks. Let's see, 3 minutes. Stefan, which commodities do you like best right now? I'm looking to scoop up some long-term holds while commodities are bottom. You have to position the commodities. I mean, that's just a must. And right now, I would say, you got to remember, we're now in a period where we have recession fears. Now, I would not enter today for a simple reason, which is, what if we have the dollar moving up tomorrow? If that is the case, because the dollar is oversold, way oversold right now. If there's any rebound, you see the metals pulling back. I would use that pullback as an opportunity to accumulate. So you have wheat that went down pretty good in the last couple of days. It's going back to the same point where we initiated the buying. So I would still add to wheat, and I already added on the dip. I added. Corn might be a good addition in this environment, but copper, palladium, definitely. Copper and palladium. Gold, that stays in the portfolio. That's going to be pretty good, and we did that last year. Continue to add to your gold exposure. As far as the other commodities, energy is still going to be challenging when we have recession fears. So I'll have really limited exposure to energy. And I already have that via stocks, so I don't need to buy the commodity either. In softs, maybe sugar has a possibility of moving up, but I'll stick to palladium, copper, wheat, corn. I think these are the strongest ones right now. SPY heading back to the lows of the day, folks. I'm holding Palantir. You have the 98.90 puts for March 14th. Since a long time, I believe down we go. Do I need to roll it and change the spread? Or in options, I still capture the gains even with such a spread. So you have 98.90. You're already in the money for the 14th, right? So if we look at Palantir here. Yeah, you're already, that trade is already done. Because right now we're trading at 84-ish. So now we want to update that trade. So we talked about a trade earlier today for Palantir. I would say book your profits from the 98.90. That's good to go for now. Let's do 85 or 80. So we'll do something like this. Palantir. Here we go. The 21st, and then we'll do something such as the 80, and then we sell the 70. In this case, you're spending $250 to make $750. You can sell it to $75 if you'd like, if you're going to reduce the cost. Still got a good chance of profitability. But right now, you have the 14th, and you sold the 90, you got the 98, so you have about $640 in profits. If we roll it down to 80, 70 for the 21st, you're keeping money in your pocket, and you're using some of the proceeds to have the exposure still. So I think this is the rational strategy that you should deploy in Palantir. Like I said, if it continues to trade like this within the 50 days, it'll probably play out a bear flag pattern and frizzle out. At that point, we have to look forward to the 60s here. 200, a little too far, but I think the 100 was closer to the 60s, 65-ish. So that's Palantir for you. Let's look at the SPY. Oh boy. I guess the tariffs are back on now. To clarify, the credit spread long-term plus buy the short-dated calls, not sell the calls, of course. Okay, so for the MNQ, but still, what happens if we see the NASDAQ flushing down tomorrow? See, that's the problem. And if you're doing a credit spread on the puts in the long run, and then you're buying the calls too, then you have double exposure to one outcome, which is the Q's rebounding, if I'm understanding the trade correctly. So this is not a really good trade, to be honest with you, because if the NASDAQ flushes down, the credit spread will cost you. What I would do is sell a call credit spread and then open a put debit spread with a longer dated put debit spread. So shorter dated credit spread from the calls or just naked calls, and then use a longer dated put spread on the MNQ. The commodity index is AIGCI. Well, that's probably in your market, my friend. This is not in, it doesn't show up here at least. Yeah, it doesn't show up right here, but now let's see if we can grab it in another way. Or actually, there we go, the wisdom tree. Got it. Okay, the wisdom tree shows me the Milan exchange here, which is kind of weird. But anyways, if we look at the daily chart, yeah, I'd avoid it too. I'd avoid it too because I don't know which one is tracking which here. I don't know what commodities is this ETF tracking, and is it tracking properly or not. I'd rather pick my individual commodities here. I would say stick to some of the grains, pick your pick. Soybeans are okay too if you like them. I like wheat and corn, and then palladium, copper. Stick to these four for now until the picture improves in energy. Okay, still in the 580, 570 puts for the 21st with the 585 call hedge. Keep everything as it is or extend. So we might actually book the profits in the 580, 570 today and do something as a lotto for tomorrow instead. So I'm inclined to do that instead. Just close the 580, 570 today. 585 as a hedge, it's a little too far for tomorrow. I don't think that's going to work out. But it's worth keeping in case there's a big pop higher. Sure, it's the kind of play that you want to do for a squeeze kind of scenario. But I think we need to do something in the puts that is closer to 570-ish for a lotto for tomorrow. So I'm going to update that in options tracker in a minute here. I'd like to keep my JD position as long as, however, I want to navigate any short-term fluctuations. Shall I go with the 42-47 strangle? Your max pain is 42. Well, the only way to keep your exposure in JD, if there's more pain to come, is to have a put option. That way you have it in the 42, right? You have the puts at the 42, so if it goes below 42, you exit. Maybe there's a taxation responsibility, right? You don't want to deal with that right now. But if you have the strangle, if you buy the 42 and then you buy the 47 calls, that doesn't make sense to me. So I would say just buy the 42 puts right now and have that as a hedge. Now, mind you, it's going to cost you, right? It's going to keep a hedging cost in your portfolio. But when I see an action like this, where we see an initial pop, it's used as a selling opportunity, we usually see more where that came from, because we had probably short-term traders that are now booking profits in JD, and the hourly hour size way overbought, probably going to roll over. So my 2 cents, either have the 42 puts or exit and then enter again once we find some support, 42 or 41-ish, enter again. If you have taxation responsibility, then you probably want to do the 42 puts, because in case there's a flush down, you can exit here at 42 and then see what happens after that. What is the likelihood of the jobs data coming out hot versus normal? I don't see how it comes out hot. I mean, which sector? Leisure? Government? Healthcare? I don't think we're going to get a hot number. I think it's probably going to be a lower number, a weak number, and it's going to freak out the market. Everything is possible, of course, but I'm going to have bets by the end of the day betting on a big flush and a rebound too. So we're going to have a balanced approach before the end of the day. Are all of these huge swings caused by zero DTEs, or is there something else going on? Mostly zero DTEs. So if we look at the SPY here, you always need to look at the contract closer to the money, right? So right now in the calls, they pretty much cleaned up. See here, the calls had advantage when we're trading at 577, 576. But right now, if I look at the expiration date of the 6, we don't have a lot of volume here. We have 29, then we have 65, and the volume in the puts now, the one in the money is already huge, and out of the money we see bigger contracts. If they continue to buy these, they'll be able to flush it down. So now we have 575, 570 could be in the table. But what happens though, when the traders book the profits here at 575, 574, then they move back to the calls and they trade it back and forth. But right now, it looks to me as we're setting the stage right here for probably at least 73, 72. Those are going to be revisited. And if that's broken, then 570 becomes a play, because they're still buying the 570 puts. And they're giving up here on the 574 calls that are nearest or at the money. So advantage goes to the puts here. So we're heading back to the lows of the day, folks. Funding to insurance companies to buy back shares allowed to reallocate 1% of their assets to physical gold. Insurance companies get unlimited funding on cheaper loans to increase their assets, including big companies in Shanghai, Shenzhen, Ping An, and China Life are the biggest insurance companies based in China. Is there a good time to enter or accumulate these names? You started with 500 shares of each of these names. Yeah, I would look, the insurance companies, even the Chinese ones, those are okay. China Life, of course, is the one that we're probably going to go with if we're going to choose that route. Because the insurance companies, like you said, it's a necessity. It's something that the consumer is probably not going to cut, but there is exposure, though. To be honest with you, there is exposure to the cyclical economy, meaning if we see higher layoffs in the U.S., and I'm talking about U.S. companies now, China could be a different situation. But looking at the insurance companies in the U.S., if we have layoffs and loss of jobs, a lot of businesses have to reduce properties. A lot of companies will have to reduce the employment insurance cost. You will see a lot of folks who own multiple properties, for example, selling some of them. And that's going to reduce the reliance on property costs. So you see the insurance, they look pretty good before a recession, but then once we get closer to the recession, they begin to frizzle out. So be careful with them. I'll give you an example here. If you look at the insurance ETF, the KIE problem, let's look at this one right here. Probably not going to be the best example, but you can see the outperformers here all the way to 27, but then it weakens. As the economy heads into a recession, unemployment heads higher. Insurance weakens, but let's see here. That's a newer ETF. If I look at Chubb, for example, this is the strongest of the bunch. The Warren Buffett pick, which is doing pretty good right now. But looking at the last recession, you begin to see the weakness here. It crashes along with the market. It does pretty good after that. So there is a degree of resiliency when it comes to insurance, but you have to be really careful with it. So Chubb is one of the most resilient companies in insurance because it caters to a lot of higher net worth than that. So Chubb, I would say, the best name in the game in terms of insurance. I'd be careful with stuff like Progressive. I'd be careful with stuff that could be more tied to the cyclical economy. Now, you can look at life insurance, be it in China and here, like MetLife, and if we look at Prudential, for example, those are going to be okay. Those usually have a reliability when it comes to a recession. They do pretty good. So if we look at MetLife, right here, you see that MetLife, I mean, we got to remember, in 2008, we had the AIG problem. So that could have been tied to it. But usually life insurance have a better degree of resiliency in economic downturn. But bear in mind that insurance is not immune from a recession. It weakens too. Unlike, say, commodities that go down, copper, palladium, they go down when the dollar surges during a crash, but they recover right away. Gold goes down, but it recovers right away. But the insurance companies go down, and it takes them a long time to recover. Unless you're dealing with, let's say, affluent consumer, affluent insurers, they're not really tied too much to the weakness in the economy like in Chubb. So just keep that in mind. I'm going to go to the SPY here, folks, the 3 minutes chart. Oh, boy. We're now at the lows of the day. Got to bring that dog, that Commerce Secretary, back on TV again. When you have naked puts, are you at the risk of losing just 100% or a lot more than 100% of your investment? No, if you have a naked put, any option, you're losing just 100% of your investment. So you know exactly what you're going to lose. That's the beauty of trading options. You only lose more if you're selling options. If you're selling puts, if you're selling calls, then your loss is unlimited. But if you're buying puts or calls, your loss is limited. Whatever you invest, if it goes to zero, it goes to zero. That's it. The contract becomes worthless. Anton, Trump said he will delay Mexico tariffs on goods under USMCA. So what is not in it? Is there a trade we can place? I'm not going to take the word of the administration, to be honest with you, because they're playing a lot of games here. The tariffs are supposed to be already underway, so we're going to begin to see food pricing increasing because of the tariffs in Mexico. USMCA was more in the autos and the commodities. I don't think the food was included in that, at least the fruits and vegetables that will increase in price immediately as we see the tariffs in Mexico. So I would not really play anything regarding the exemption here because I don't think they know what they're doing right now. They're just coming out to soothe the market, but as you can see, the market right now is saying, you know what, we had it. Either you're going to do the tariffs or not. So I think right now we're going to concentrate more on what the indice is going to do because we're breaking the wall of support here as we speak. If the dollar is very oversold, then risky assets will have to go down at any point in the next few weeks. Isn't a good idea to bet on the downside? Expiration date 2 weeks. FXI puts. Okay, so FXI is China, and that's going to be different. If the dollar rebounds, sure, you'll see pain in China. So if that's what you're betting on, I want to say you got to monitor how the dollar is going to trade in this session. And right now we have a warning sign, right? Because you see the market going down and the dollar heading higher, which tells me if we have an ugly jobs data tomorrow, we're going to flush down and you see the dollar rebounding, and yes, FXI is going to go down. So if that's the bet, you're on the right track here. Keep it as it is. Gabak. Question, why would you buy stocks if you want to make profits? Would it be better to play options, except you want dividends? Well, the problem, options are risky, okay? So options you can buy, you lose 100% of your profits, or you lose, 100% of your bet. In stock market investing, it's less risky. You produce lesser rewards, but you're not risking a lot. So from my positioning, for example, I would say 70 to 80% of my portfolio is stocks. 80% is stocks and bonds. 80% is more in the trading, say short-term trading, either stocks or options. And that depends on your age too. If you're in the younger side, you have to take more risk, right? You have to accumulate and make a net worth for you. So you have to trade more options. But you have to be careful. You have to be really disciplined that if a trade goes against you, it doesn't look good, cut the loss. Don't overinvest. Don't overcommit in one trade, because you can always have multiple trades. You can have always a better trade, a better setup, an easier setup to make money. So if you can have that discipline and you're on the younger side, yeah, I would say maybe you can do 50-50, 50 stocks, 50 options. But you always have to have that option, stock portfolio, because that's the most reliable method in wealth creation. It's owning stocks. The VIX is moving higher, folks, and the SPY is kind of flirting with losing support now. Oh boy. See, this is problematic. You know why? Because we already got the assurance by the Commerce Secretary that we have a delay in the tariffs. And the market says, yeah, I don't care. I'm going to throw a fit right now. So that's a bad sign for the market right now. Yep, we're above 24. That's problematic, folks. Let's see here. Emma Gardner, you own NTR. Well, that's a good gardening stock. Not really, but it has some relationship. If you ever have an opinion on that, been nursing it with covered calls and puts. So let's do NTR. By the way, you don't need to do a lot of option strategies on your stock positions, because in the long run, it's going to cost you money, right? If you do covered calls, it's okay. Puts, usually we want to do that if we lose, let's say, a moving average or we lose support, then we want to do puts. And right now there is risk in Nutrien that it could go like this, in inverse ABC, and heads down. Right now the VIX is just moving up in a big way, and it might drag everything down with it. So in this case, I would sell the 52 or 51 calls and then buy the 48 puts as protection. And that way, if we go below 48, then no harm done, we just exit. But I would remind everybody that if you look at Nutrien or Mosaic, and I often bring this trade because it was my best trade back then. You see what happened here in Mosaic when we got into the recession fears and all of that? Mosaic exploded higher. And this was my best trade at that point. And then it crashed really hard. So leading into a recession, you could see these agricultural names actually moving significantly higher. But once we get the recession fears, Bear Stearns began to happen right here. That's the point where you're, okay, I'm out of here. And it doesn't recover the same way as the commodity wheat, as gold, as copper, as palladium. So that's something to keep in mind, that you can play it all the way in a recession theme, heading into a recession, but once we begin to see things breaking down, you get out of it. Did you say the jobs data that moves the TLT more than other economic news? Well, it's going to move the TLT more because you have the 10-year, and if we have a really bad number, as a lot of folks now anticipate, it's going to be just a shit show tomorrow. Then bond yields will go down, and that means the TLT is going to rocket. It's going to move up. So you see maybe an energy release right here, and TLT heads higher. That's the assumption if we have a bad jobs data. Hey Mav, I'm on a flight, not able to watch the stream as YouTube blocked during the flight. If possible, to post highlights from the stream. Yeah, okay, we'll do that, because this was a good session. Like, sometimes there is a session where we talk about routine stuff, and it doesn't really produce anything. But if we have a session like this, we'll do it. Cost earnings or Costco earnings could be interesting. Trade like an AI stock. Growth is limited. Upper middle class is feeling the pain. Yeah, I'm with you. Look, maybe Costco, finally, it'll be a put option trade today. I'll do it. I'll do something before the closing bell. I'll do something against Costco. So let me write this down so I don't forget. Let's do Costco and let's do jobs data lotto tickets before the close. Impact Wonder. This almost looks like a repeat of Wednesday morning. Yep. It's just, it's uglier, I would say. It's uglier because you just had a confirmation. Look, now they're going to bring this guy, Besant. At some point, they have to have clarity. What do you guys want to do? Are you just going to freak out every time the market goes down and back off? Because at some point, maybe we're at that point right now, when the market is saying, I don't care what they say. I'm just going to get out because this is too much uncertainty. I don't know where I'm supposed to invest, how I'm supposed to trade. Let's just get out. Let's book profits and get out. And especially if you have the uncertainty of the jobs data tomorrow. So buckle up, folks. This could be a really interesting session here. Let's check on Patreon before we go. Jeff, thank you so much. And Firecat, appreciate the comment here. Michael. Oh, we have a bunch here. Let's would be great to share how you set up your screen on TradingView in such a way. MACD, RSI. Let's do that right now. A lot of folks ask that question. So, Vortex indicator, plug it as it is, right? RSI, I play with the settings a little bit just so it looks a little bit. Again, the input is still the same. You don't want to play with the inputs, by the way, because they react the way other traders react to them. And pretty much everybody has the default setting. So you can screenshot all of that. I mean, I'm just looking for a friendly visual here. So you can see the RSI, you have your MACD. You see the settings right here. There we go. I have the signal, and I have all of my inputs, again, the default inputs, all of them. And then here in the regular chart, I'm just playing with the colors, and that's pretty much it. I have the background here, just playing with the colors right here. That's it. So hope that answers the question. Now, would it be better to get stocks when we are in a market crash? Otherwise, you could be down for years. Well, right now, not a good time to buy Microsoft, not a good time to buy Apple, not a good time to buy Meta, right? Netflix, not a good time to buy a lot of things. It's a good time to buy some of the defensives because those are still going to work out. And you got to understand that, folks, majority of us need to have exposure to the market either way. For example, my majority of my net worth is in my pension. In my pension, I have to be long something. So unfortunately, I'm out of, when I see a market like this, I wish I could cash out and do something else with it, but I can't do much. I can rotate. And the way I can rotate is, for example, go with the RSP, because in a day like today, the magnitude of the drop in the RSP is lesser than the SPY. I would go with GLD. That's what I did. Went with GLD. I went with some of fixed income ETFs too, as in to reduce my risk and my long exposure. Now, after a market crash, would I be buyer of a stock? Of course. Because Warren Buffett will do the same thing. Michael, hey Mav, thanks for all you do and sharing your knowledge. Are there any bazooka trades on the horizon? I'm thinking about that 570 it puts on the SPY. So we might find some stability here, but we might want to go with that 570. 0 DTE or for tomorrow. And that VIX went with the VIX 70 even for the March 26 expiration. So, but would it be bazooka? Would I shoot a lot of investment here in 0 DTE? Not really. I would say if we close below this support, if there's confirmation that we lost the 200 days moving average, if the jobs data comes out bad tomorrow, then all the evidence will say that we're heading into a bear market, and the initial flush in the bear market usually causes a huge spike in volatility. So that could be a bazooka trade. But right now, I think it's 570. is the target that we're eyeing because it is the mechanical support here. See, as they keep pushing it, and they're probably going to get it closer to 570. This is what they're trying to do right now. When are we going to make a video about unusual activities? Hopefully this weekend. Hopefully this weekend we'll do some of those, or the options 101 video, which I think will be more helpful. You like that more than the unusual activities. Let's do that first, and then we'll do the unusual activities. Which type of positions would be best to close in a day like today in preparation for the next day, or higher chance of downside than upside tomorrow? Risk on, right? All the stuff that you have in risk on, if you don't have puts on it, if you don't have any insurance policy, you probably want to close that. If you have bets, for example, on a rebound that already played out, you usually want to book them quickly. I mean, this kind of behavior is a bear market behavior because you see downside, sharp rebounds, but you have to close the calls quickly, and then we head down. Sharp rebound, then we head down. Sharp rebound, then we head down. That's behavior of a bear market, really. So your strategy is going to be similar to the 22 strategy. You got to stick to longer dated puts and then play these rebounds, oversold rebounds, sharp rebounds, bear market rebounds, whatever we're going to call it, using shorter dated calls. Gabak, you say that you sold almost all of your stocks a few months ago. Now you're shorting everything. It seems that the way to go for now. Would it be better to let it pump and short at the peak? Well, I don't know if we're going to have another pump here. Right, so if you sold your stocks and now you're positioning in the short, this is what I'm trying to do right now. This is what I'm doing, positioning more in the shorts. But also have longs. I also bought the defensive stuff. So you can stay in the defensive like Kroger, like the pharmaceutical names, some of the insurance names. You can still stay in those. The metals, you can stay in those, some commodities. But the options becomes limited. And again, in a bear market, you have to short. You have to participate in the short. Financials, technology, the cyclicals. Some of the industrials that went crazy. All of these names are worthy of shorting. So I think you're in the right positioning here, and just stick with it. Stay with the same strategy. Folks, we're going to wrap it up right here, but in 10 minutes or so, we'll be back in Discord. So again, any update, we'll cover it right away. But thank you for joining us in this session. This was a good one. And good luck with the rest of the day. We'll catch up later. Take care.